Today we have with us Mr. Umesh Kumar Mehta, CEO of Samco Asset Management. Samco has just launched its first ever mutual fund in the industry, so we thought it would be right to get to know more about the fund house, its investment philosophy, what all investors can expect from its FlexiCap fund, and know more about its future plans. Thank you, Umesh, for doing this interview. We see that the AMC is going all guns blazing in the launch of your FlexiCap fund.
We are on the hot seat, and now for next 15-20 days we are absolutely ready to fire all cylinders, and we've been doing since last 3-4 months. So we have we are India, going out, meeting people, conveying our thought process to distributors, advisors, and people are really excited.
So actually, we usually have interviews with fund managers, but since we saw that you have background with research and also you have been since quite a long time with the group, so we thought it would be right we have an interview with you.
Yeah.
So our first question was like, we understand Samco's sponsor, the Samco Securities Limited. It's like an equity brokerage firm founded in 2015 by the CEO, Mr. Jimit Modi. So like, can you please explain the background of the Samco group and what were the driving process to get into this AMC business for the group?
So eventually, ultimately, this group was established way back in 1993 in the name of Samruddhi Stock Brokers by Mr. Vipul Modi. And then in 2014, we rebranded ourselves from Samruddhi to Samco. So it's so this is how broad. So Vipul Modi, is our founder chairman. And 2014, when second generation came in, Jimit Modi, he was early adopter of technology and innovation. So we were early to enter into discount broking way back in 2014-15. And our thought process was, we really need to innovate, add value for our investors, customers, then only we will be able to create something really big. So back then in 2014, we were the first to bring celebrity as our brand ambassador. We were the first to bring trading league competition on the Indian shores for the first time. And once we were running that, there were so many people. There are thousands and maybe so many multiple peoples were trading, were investing. So in the investing league, people, those investors who outperform in the monthly, quarterly, or annual leagues were the one who were rewarded. So, and there was thousands and thousands of investors who were also losing money. And so I was the one who was charged to understand the winning investors philosophy, take them, share them, so that everyone across our platform and media at large, country at large can know their ideas. And at the same time was also understanding and reading all those investors who were also losing money, talking to them, because eventually they were part of the league. The crux was, it is very hard for investor on himself, making consistent money, because there are 2-3 factors. Number one, the first and the foremost hurdle is his own mind, his own mindset. Either he is not able to control his emotion, or he is not disciplined. Either he overbets, he does not do proper asset allocation, or he just bets on 1 or 2 stocks. He goes by whatever is available on whatever his friends, social media tip. So that actually that way investor cannot really make money, and he cannot really make big money in his lifetime. So early on, our thought process was, now if we want to really add value, because no amount of mentoring, no amount of knowledge, people were able to do things correctly as an investor. So they kept on repeating the same mistakes time and again. So we thought, if we want to really add value to our investors, we also need to enter into asset manufacturers and get into this business, so that over a period of time, as and when this is a long process, when we get into, we will really add value to deliver what investors want. Typically investors want good, decent, risk-adjusted return, and during downfall, the portfolio should fall less. So this is what investors want: good returns and lower risk and lower volatility. So so just to sum up, 1993 traditional stock broking to 2014 discount broking, and then 3 years ago, 2018 we applied for mutual fund license, July 2021, we got final mutual fund license. And today we have a board, Sri G.N. Bajpai ji, who is chairman of our trustee, Samco Trustee Company, and Sri Ashok Kakkar ji, who is the chairman of our Samco Asset Management Company. Bajpai ji requires no introduction, former LIC SEBI chairman, and Ashok Kakkar ji, he was former executive director at SEBI. And we have also on board on Samco Asset Management Company, Sri Kannu Doshi. He is also senior chartered accountant. He was earlier on board of Motilal Oswal, Nippon, and Edelweiss AMC. So we have a great pedigree in terms of our governance structure, and we have a solid running team. And the idea was that we now really we need to add value to our investors by on the manufacturer side and give them a product. So what kind of product, what they want. So this also sometimes in 2017-18, we hired a research agency. That research agency does research for FMCG players. Our thought process was that 100 crore people can buy soaps. So why are we struggling at around 2.5 or 2.5 crore unique PAN in mutual fund industry? So with that thought in mind, we had hired an agency. And the outcome of that research was, number one, investors say if they are giving us money, they want high return, and at the same time they want to stomach lower risk and lower volatility. So these are the three things combined that investors want. And we, if manufacturer, if we deliver that, then I think our role and purpose will get served. So broadly, that was our thought process and journey, how we evolved, and why we want to cater to, and so why for the matter that this is the reason why we intend to enter into AMC business.
Okay, so it's good to know, like, investors need a background with respect to money, where they're putting in the money. If they know the background, it's good for them. So it's good to know that. Your investment philosophy seems to be built around stress testing, and which is based on your Hexashield framework, which usually tests and evaluates businesses on 6 important facets of risk and stress. So can you explain a bit about the evolution or genesis of the framework and the investing principles on which the framework was built? And also, is the screening of the companies, which is done as per the framework, is it an objective way, autonomously, which is done, or the fund manager's skills and judgment play an important role in the entire process? So we wanted to understand.
Okay. So first of all, evolution. So we've studied 100 years of US market, how wealth, what were the attributes of wealth creation. So S&P 500 was available at lowest P multiple in 1917, which was 5, and the highest P multiple of past century was in 1999, that was 34. So we bought low and assuming we sold high. So that typically for 82 years had generated 2.3% CAGR return. But the total return S&P had delivered during that same period was 11.6%. So 11.6 minus 2.3, so 9.3% return got generated, because fundamentally companies were able to survive World War I, World War II, grow, reinvest and compound. So of this entire 100, 20% is valuation, what we buy low, sell high, and value investing, what we call, and 80% is fundamentals. Eventually, if the fundamentals of the companies are strong, if they are able to generate profit, grow, reinvest and compound, that is where 80% of the value generated over the last 100 years. So that being the process, so that being in background. So now, what is stress tested investing? So let me straight away come to stress tested investing is deploying money in those businesses that can survive and endure stress or variety of shocks in the economy, first, and second, are able to generate high risk adjusted return. So why? So why stress tested investing? Because life of the businesses are getting shorter nowadays because of venture capital funding, because of infinite technological disruption. So that's the reason why 20 year ago, say 30 Sensex company, today only 6 are there. Or for that matter, Fortune 500 companies, half have disappeared in last 15 years. And 3 months ago, Evergrande, a Fortune 500 company, disappeared. So first of all, we need to first check the survival. Otherwise, there is a permanent loss of capital. So first survival. And then second, there is one key matrix or the holy grail, what we call, that we can identify to all the wealth creation. And that is high return on capital and high reinvestment rate. This is a holy grail, wherein we can identify that all the wealth got, and that is what also was available in our S&P 500 data, that research. So what is stress tested investing? First of all, it will check for survival, and then second is the business compounding machine. So this is our broad philosophy. So why stress tested investing, or what is stress tested investing? So this is our philosophy for our investors. So any philosophy needs to have systems and processes to get executed. Otherwise, on the whims and fancies of fund manager, or for that matter, IC committee, we will not be able to do anything consistently at a size and a scale. Therefore, we have built a process, and that process is that hexagonal framework, that 6-facet hexagonal framework that we have built. So broadly, it covers what, and I'll cover 1 or 2 points in detail. But broadly, it checks the fundamental strength of the business. Will business survive? And in good times, will the business deliver high return? So now let me straight away come to few of the important facets of our hexagonal framework. Actually, all are important, and they all check the fundamental strength of the business. But let's understand growth and reinvestment. See, without growth, there is no point investing, and the company becomes born. Therefore, growth has to be there. But after growth, what? So typically we see Q on Q, YOY growth. But for us, that is the beginning of a story, because after growth, company does 3 things. Either it will give dividend, or it will repay their loans, or it will reinvest. This is where majority of company fails our stress test, because either they are not reinvesting, or the reinvestment rate is poor, or they are giving out dividend, or they are repaying loans. So for example, Castrol, everything that the company earns is paid out as dividend. Steel Authority of India has seen a massive run up, 200-300% growth in every penny that the company has earned in last 1.5, 2 years. They have repaid as loan. So they are not reinvesting in the business, and therefore capacities are not being built, and therefore compounding is not going to happen. So growth is historical. Today, if I enter, given the growth is all past, so what we check is, number one, is the company generating high return on capital. I think that is the number one grade. So 25% is the minimum benchmark, and therefore so many companies below that will fail our stress test. And second, are the companies reinvesting in the businesses again at an incremental higher rate? So therefore, so many companies, and some of the companies that will pass. And then let me again quickly cover, this was growth and reinvestment. Then the other facet is corporate governance. We measure the turnover of independent director, how many are associate, and all those promoter pledge, and all those things. We have auditor quality checklist. So there are so many things, and ultimately we arrive at a final score for corporate governance. And similarly, pricing power. See, companies, there are 2 types of companies: those companies which have got pricing power, and those who are price takers. Those who are price takers, they don't control have over the prices, and that one was cyclical, cement, steel, your textiles, all these companies will not pass our filter test, because what these companies are prone to mean reversion. And mean reversion, what we mean by, if they are making good money, they will get finance, and expansion will happen, because banks are ready to finance tangible, what they can see. Companies that will pass our filter are the ones which have got large intangibles. Intangibles can't be seen, and therefore the companies will be able to sustain, grow, reinvest, and compound, and they will be the ones who protect the return on capital. So this is broadly how our investments, and regulator also is nowadays kingmaker. Either it makes our life, or it is going to make our life horrible. So similarly, all 6 parameters, company passes, we have got balance sheet, debt, corporate governance, cash flow, stress test, regulator, and growth reinvestment. So in all these things, if the company passes, it passes. So out of Nifty 50, today only 15 company passes our stress test, and 70% or 35 companies fail the stress test, because of all those 6 parameters, our tight parameters that we want to check for our investors. And see, as I told you, our thought process was, the way back in 4 years ago when we did that study, investors want high, during good times they want high return, and during bad times the portfolio should fall less. So now let me explain how we will be able to deliver that in good times. So our internal benchmark, as I told you, is 25% return on capital. And what Charlie Munger had said, that the long-term return of stock can be no different than the underlying return business generates on its capital. So that is what we are basing, and high reinvestment rate. So those are the kind of companies which will always be ahead in terms of their delivery of net worth, the delivery of the pool of the money that they generate. And during bad times, because our stress tested framework is tight, companies with either zero nominal debt, companies which have got pricing power, companies which are able to generate cash even during bad times. So those are the companies which will fall less when the market fall, and when market rises, because our benchmark is 25% return on capital, we will rise far higher. The current, according to our understanding, there are 1,000 plus schemes. The weighted average number, this RO, return on capital, is all low below, and that's the reason why we are seeing low teen, high teen returns over a long period of time. But our portfolio, because investors want that kind of that they are aiming high, so we have based our benchmark. Unless company generates 25% return on capital and there is high reinvestment rate, we will not invest in those companies. So today we have a very limited pool of companies that are investable companies, because we have this system, 67,000 companies globally. Today we are able to scan through, and 125 company passes our stress test, and the flexi cap, the NFO which is on, will have 9 international names and 16 domestic names. So now to answer your question, what is the role of the fund manager? Is there an objectivity, or it is is algo based or whatever? See, today technology, our thought process, our investment capabilities and skills are there in our head. But if we want to do it at a size and a scale on globally, we need to take the aid of technology. So that is what we are doing. So processes and systems are there to filter out, and then as human beings, as IC committee, as human brains, they are there to, as a guardian, to check all things are right, as per processes, and then eventually the IC committee takes a call that is the price insane, because price also has to be reasonable. There is no point, just because the Hexashield framework will check only the fundamentals of the company, the fundamental strength of the company. And the price is a discretion of our IC committee, and then that's how they also look into price. And so there are more that I can add, but now we'll keep for the next question.
Right. So as I understand, the framework is just to get you the universe of investable stocks, and then the fund manager's discretion, the portfolio is built on that. Okay. So in your unit holders handbook, which is something which you don't usually see in a lot of AMCs give out, you mentioned that you aim to pioneer the concept of stress testing and truly active investing. And you also claim to be the first mutual fund in India that will transparently disclose all voluntary dealing costs. So what differentiation Samco would be offering to its investors in addition to active investing and higher transparency? And also, like, how disclosing voluntary dealing costs help investors in any way, because the final return, what they get on their invested money, is what they ultimately matters to them. So can you just elaborate on these?
Mohan, first of all, we are pioneering stress-tested investing, because just like in manufacturing world, or for that matter in banking regulator, a company goes through stress test on a variety of factors, whether during bad times will the company survive, or for that matter in our manufacturing side, we are buying a car, but if something goes wrong, will we survive? So that's our thought process. That's what we want to do this on the investing side for our investors when we give out a portfolio. So that's point number 1. Point number 2 is, after doing that, today, because investors are also smart, they have also evolved over a period of time, and mobile has all the more intelligent. Today, they also need to be given a valid, authentic reason. If they are paying active, then they should have a portfolio that is widely different from benchmark or the index. If we are just repackaging index and then we are selling it at an active fee, then to that extent, we are not truly acting, or the trust factor is lacking. For an 80 plus index, and we are charging, index fund is available at 20-30 bits, and then we repackage it as 2%. That is where our thought process is. We need to build highest transparency and disclosure, because ultimately it is he investor, it is his money. We are only an intermediary, and we are bound by all rules, regulations of highest transparency, disclosure. So we also have to do it and prove ourselves that, look, this is it. This is how we are doing it. What others are doing, we don't know, but this is how our thought, this is what our fund will be. We will have an high active share, because if investors are paying us active fee, we will give them a portfolio widely different from index. And as I told you, so that's number 1, our thought process. Second, as you told, voluntary dealing costs. See, as you said, investors require the kind of return. but investors should also know what's underlying, or what's the velocity, or how returns are getting generated. It's not only the return, it's also the how, because investors are smart, they want to know. So our thought process is, let's have a complete transparency. Look, if this is if we have a low churn, let's disclose that. Look, this is our voluntary dealing costs are around 5 bips or 10 bips, because this is what we are intend to do. So whatever we are doing, we are disclosing that transparently without any legacy issues. So this is where we think that investors need to be informed in every. It is his money, he's the owner, he has a right to know everything. And as intermediary, it's our duty to tell him, disclose him what the actual state is. And therefore, in that perspective, active share we will disclose, because if he is paying 2% fee, we have to do justice, and we also have to justify ourselves that, look, this is what this is there. And VDC, voluntary dealing cost, is this to add to the ultimate disclosures in the interest of investors.
So it's good to know, like, you're focusing more on transparency, and you're having, like, pioneering the way the industry should ideally work. So it's good to know you're doing that. So we were, like, very curious, like, in an industry where there are growing voices in support of passive investing, what was the reason which drove Samco to position itself as a truly active investing fund house? And also, do you think this conscious decision of not participating in the passive investing trend may put you at a disadvantage, since a lot of inflows have been in the index investing have been on the rise in recent years?
Passive investing or index investing actually is a good concept in a way, because those investors who actually don't know about market and they just want to invest and remain invested, for them passive is or index investing is good. But the other are so for 40-50% of wealth on a large term basis, let investors, if they want, let them do passive investing. But index again, see, then active investing in active, and when underlying is all about index again, and so that is where we come in. And he said, let's have a good 20-30% of your portfolio into truly active, because if you want index might as well go for your ETF investing or passive investing. Why then you pay a higher fee, and then you are in the middle of somewhere, you just get everything, or larger component is index, and still you are paying that active fee. So this is where we are. So let the passive space be there, but we will pioneer always. We will always be on the active side. If investors are paying us active fee, we will always try and find the best for him, the most efficient, the best companies that his money can generate on his. So that's our thought process. So there are two ways of making money. Either you buy the biggest, that is index, or you buy the best, that is we. So we will always be on the side of active. Let's focus on. There will always be jewels. In India, since we have a lot of India is a developing country, there are still a lot of potentials, and we are pretty sure that. And also we have a global exposure. So overall, on the 67,000 companies globally, we will be able to fine tune. We will select great companies, great businesses, franchises which have got high return on capital, high reinvestment rate, great corporate governance, great balance sheet, great pricing power. So those are the kind of companies which will keep on rising, and that's how we will create wealth for our investors. So this is where we will always be on the active side, but truly focusing on the best and the most efficient companies for our investors.
So whenever, as an investor, whenever we go to invest in any mutual fund, like, we usually see the fund management and the experience and other stuff before investing. Like, so we see that that is what investors prefer traditionally. So can you please give a brief background about your fund management team, and also what they bring to the table in terms of managing the funds, and what are the plans regarding scaling up your fund management team in the near future? Because if you'll be launching more funds, would you be scaling up in that sense?
Okay, good. So currently, our fund management team comprises, there is an investment committee, IC committee, wherein the rank holder, chartered accountant, CF is there. I myself, Umesh Kumar Mehta, CA, MBA, and I'll just add my little bit more background sometimes later. We have Mrs. Nirali Bansali, engineer, MBA. She is fund manager domestic. and we have Dhaval Dhanani, CA. He is a fund manager international. So combined together, we all four have around 60 plus years of experience. So Jimit Modi has around 15 plus. I have around 24 plus. Nirali and Dhaval also have around 15-20 years combined experience total, both of them together. So broadly, it is all about understanding the philosophy, aligning ourselves with those thought processes. And as I told you, so this we four are this, and we have research, our head research, Paras Mataria, chartered accountant. So we five are there in terms of to overlook and oversight into our investable universe, and then 25 stock that we as a flexi Samco flexi cap scheme will have, and we are on our toes. See, because we have a systems which takes data on a real time basis, so we are on our toe. It's every second things are coming on our way and getting processed, and therefore we have to be very alert in terms of understanding to what our entire universe is 67,000 companies, what's happening to our 125 companies, what's happening to our invested portfolio of 25 companies. So it's an exercise which is all which has to be done to teams, and we have that capability. So this is what we base for next, at least till we venture into debt or other things. So that currently we intend to enter into since next 3-5 years, and our core competency is equity. So this is what is there. Plus, we also have, along with our research analysts, software developers. So now let me give an example. So for that matter, alcohol companies. So alcohol company as an ecosystem will be similar across the world. So world over, the operating parameters of alcohol company, Indian, all international, APEC, US. So once the research analyst gives the understanding to our software developer, and then they code as a sector, as a beverage, that they have created an entire universe wherein all stocks across the world can be scanned through them on a standardized basis. So all data that we have is on US dollar basis. Even our Indian companies also we have converted into US, and therefore standardized data to go through that, and we have common frames to look into all companies and sectors. There is a like to like comparison. So that we really are able to see things in a proper perspective. An apple to apple comparison is required, and that is what we do, and India and international across the world. So this is how our entire ecosystem works on the research side, and then finally on the IC side, we four people eventually decides. So now this is, people may say that you are new, and for that matter, see track record. Eventually when 3 or 5 year old, we will have track record. But the point that we are making is our return on capital. See, the holy grail for investing, and that is what we are saying, is high return on capital and high reinvestment rate. Our company's return on capital are higher than all our available portfolios available, and they all have got high reinvestment rate. So today, if we enter over next 3, 5 years, 10 years, what Charlie Munger had said, that long-term return will be somewhere equal to your return on capital that the business generates. So this is where we are aiming for, and this is how we have built ourselves to deliver, to deliver what ultimately investors want. Investors also want high return. So we have built our investment philosophy. This is that, and during bad times they also want lower volatility, lower risk. So our will fall less during bad times.
So like we've seen last 8, 10 years, 15 years, new AMCs coming up, and they have established themselves. And within last recently, they have like gained quite a bit of name, and like investors have been thronging their funds. So hope that happens with you as well. So yeah, good luck for that. You have seen to start your business with FlexiCap Fund, which is the most widely appealing and diversified equity space among the investors. And do you have a roadmap as to the basket of fund offerings that Samco would be offering going forward? And also, what are the other products which you are in the process of finalizing and launching?
So our roadmap for next 3 years will be after this NFO flexi cap is over, we have an ultra short term fund. We filed it, but the clearance is sometimes in the next month or before March. So that, but then we will come with an all active global. So wherein best of the best across the world that is available, and then we will have one more ELSS by the year end. So that is broadly we are aiming for 3 equity side and 1 parking fund, ultra short term fund. So this is what we are aiming for next 3 to 4 years.
So, like about a FlexiCap fund, over the last year or so, we have seen many funds make provision to have foreign securities and have a dedicated fund manager for that. But we don't yet see that the proper allocation in those funds have foreign allocation in those funds. So with your FlexiCap fund, would we see a steady allocation, like month on month, we would have a certain allocation in foreign stocks, or would it change? And also, if it would change, what would be the factors based on that that decision for change will be?
So we on day one, the moment we get fund, so we have our 9 international names are ready, our 16 domestic names are ready. Up to 35% we will invest in international stocks, and 65% will be domestic. So this is what we will maintain. So there is no so this structure, this ratio will more or less will remain throughout our entire tenure or the scheme. What investor want, and therefore we will be able to give them 1 year long-term capital gain tax. So why international? So 35% is a good diversification. See, nowadays we have seen, so for that matter, all the mobiles, all these electronic gadgets, all manufacturing is happening in India, but the real brains are all available or are all international. So to just give you as a case study, to give you an example, in pharma, see, Pharma Novo Nordisk is a Copenhagen exchange listed company, Norwegian company, and they're world leader in penicillin, and they have a 51% market share, and they typically work in only 2 categories, diabetes and obesity. And that stock, 60% return, that company generates 60% return on capital and 50% reinvestment rate. And the company is available at half the valuation compared to whatever Indian best companies that we want to say. So that is what our thought process is, that there are great names available for our investors, even in international market also, for them to create that massive wealth, and plus that rupee, the dollar depreciation also might add to that, but that is all bonus. But our thought process is that are great businesses for assets to own, even in international in foreign markets, our investors to create that massive compounding wealth creation for our investors. So we are not agnostic. Actually, we are open and good that at least 35% is allowed. Actually, we would love to add more, but why? That's what income tax permits, and therefore we will restrict to 35%. So
yeah, it's good to know, like many funds they have the provision, but you would be having it.
So also let me add one more example. See, Microsoft, TCS, and Infosys. See, all companies have created great wealth for our investors. Just let me add a few important points. So because we have systems and processes, and actually we have built that way. See, Microsoft does 12% as an R&D expense as a percentage of sales, which our Indian counterpart does around 1.5%, 2%. So a company are doing 12% R&D. They will always be ahead on this planet in terms of creating products and products of pricing power. So this is what Microsoft does. So now, as a part of our efficient companies, so our NFO strategies identify efficient companies at efficient price and maintain an efficient churn. So on the leg of efficient company, because Microsoft does 12%, and when we standardize the data, the profit of Microsoft is double, because R&D is an expense for future and not to run the current day-to-day operations. So actually, as is where is Microsoft is a far better business model, and they are getting so the valuation is half. So currently, Microsoft on an accounting basis, all companies are available at 30-35 PE multiple. But when we truly see the efficiency of the company, Microsoft is available at half the valuation compared to our Indian counterpart. So this thought process, that if investors' money is there, let's invest the best that their money can get on this, the returns that their money can get on this planet. And this is our thought process: investing in great companies at fair or reasonable price, and those are the kinds of business which have got high reinvestment rate. So Microsoft has got 60, 65, 70% reinvestment rate and 25% return on capital. I think a massive compounder for times to come, and these are the kind of companies which investors will benefit a lot. So these are just a case study to give you an idea to look what our thought process is in terms of how we look at businesses, how we look at markets, how we look at valuations.
That is really great to know the thoughts and efforts you put into your investment ideas and philosophy. That would be all from our side today. We would continue our interactions in the future. Thank you, Umesh, for taking time out to speak to us and help our viewers understand about the fund house and the evolution framework at the AMC. Thank you very much.
Thank you, Valuely sir.